Hello and welcome to Making Money with Forex, Module 8, the bonus module. I'm your tutor Jeff Fitzpatrick, and in this module I'm going to look at what you can do if things go wrong. And believe me, they will go wrong on occasions. So it's very important that you note the techniques and tips in this module and use them effectively as and when you need to. Study this module very carefully and practice the techniques that it teaches. So let's get straight into it. When things go wrong, one of the easiest and most straightforward ways of defending the position is simply to wait, to give it time for the trade to come back in your favour. But how long? Well, it's not necessarily a question of time, it's more a question of how far against you the trade goes. And I would say that within the range of 20 to 100 pips, you should probably be thinking about taking action. When within that range is really a question of proximity to major pivot points, such as Jeff's lines or whole numbers. A second defensive technique is to use a stop-loss order. Now that's not something that I normally do. I prefer to use some of the other techniques that will follow. But a stop-loss order, which we've covered in an earlier module, is a legitimate defensive technique, and there are occasions when it's right to use it. The next defensive technique is probably my favourite and the one that I would use most frequently. It's to use an equal and opposite trade. So if the original trade was a buy trade, we would place a sell trade, and vice versa. If the original trade was a sell trade, we'd place a buy trade. The defensive trade would be equal in volume, that's bet size, to the original order. So if we have a buy trade of volume, say 4, that's gone against us, we would think about putting in a sell trade also of volume 4. Once placed, the pair of trades then needs to be managed. It's our practice always to set a pending defensive order, just in case it's needed. If we're not watching the screen closely, or in case there's a major news item. So what I'm saying, listen carefully, is that a default defense that I use is to place a pending order for an equal and opposite trade, just in case things go wrong. In the next part of this module, we'll look at managing these trades, bringing them closer together and eliminating the defense and walking away from the situation in profit. So let's go through this slowly and carefully. So for example, we have a buy trade shown by the green line in this slide set at a particular price. The blue line is the price movement. Initially, perhaps the trade goes in our favour, but it turns and the price goes against us. It's these circumstances that we're talking about defending, and it is here that we will put in a defensive sell trade. So time has elapsed, and eventually, you can see by the I think it's sort of purple horizontal line, I've put in an equal and opposite sell trade. So I've now got two trades, the original buy trade and an equal and opposite sell trade. The gap in between them I've represented by a £50 loss. Now, irrespective of what happens to the price, if the price goes up or down, that £50 loss will stay the same. So we've now stopped the rot. Things can't get any worse on this trade. That's not quite true, because in an earlier presentation we noted that there are things called swaps, and swaps may give us a small and increasing further loss on this position. But ignoring that for the moment, the main loss of £50 is locked in. Doesn't matter what happens, up or down by how much, the loss will stay as £50. So next we need to look at how we manage that loss out of existence. So time has moved on and the price has gone down so that our new defensive sell trade came into profit. We waited until the price action turned around and started to rise again. As it came close to our defensive sell trade and therefore was still in a small profit, we've taken the profit and allowed the price to continue to rise before putting a second defensive sell trade in place. So we've taken profit on defense trade number 1 and replaced it with defence trade number 2. And you can see that the difference is now £30. So we've taken £20 out of that loss position without actually taking any sterling loss at all. So we've used the defensive trade closing technique to resolve the situation at least the degree of £20. We'll continue this process, narrowing the gap until it's completely eliminated. If we'd started with an original sell trade and the price has gone against us, so now the price has originally perhaps been in our favour a little and the price has increased putting our sell trade into loss, then we're going to take a very similar action, as you'll see from the next slide. So once more, the trade has gone against us. There's a loss which in this example is £50 before we put an equal and opposite trade on, and this time of course the equal and opposite trade would be a buy trade, so that if the price continues to go against that original trade, the buy trade will go into profit by an ever greater amount, matching the increasing loss of the sell trade, and we'll have that loss trapped again. In this example, the £50 loss will not get any worse. Once again, time has moved on, and eventually the price has turned back in our favour. And the original defensive trade, shown by the dotted line, has been taken off when it was still in profit. The prices have been allowed to continue to fall, and then a new equal and opposite sell trade has been placed. The gap between the original trade and the new defensive trade has now been narrowed down to £30 again. Once more we would repeat this process until that £30 had been eliminated, and possibly even until we've got the two trades on opposite sides of one another and we've locked a profit in. Yet another defensive trade or strategy that I use is called double up. Forgive the graphic. In this type of defense, we place a further trade of the same type. So if it's a buy trade, we'll put another buy on. If it's a sell, we'll put another sell on as the market moves against us. However, this trade would be larger than the original one, though not necessarily double its volume. The profit from this trade is then used to cover the closure of all or part of the original trade without damaging the equity in the account. This type of defense is used when the current price action is a long way from the existing original trade that we're working on to eliminate and defend. Of course, the price may also put the rescue trade into a loss situation, so some risk is involved. Therefore, this rescue plan can only be used sparingly and when the trading capacity overall allows it. I would say at this point that some of these defensive actions are quite complicated. They take some practice and getting to know and getting to understand. The simulator, the demo account, is a good place to do this. But if you get into trouble, even if it's only on the demonstrator account, you're not alone. Please feel absolutely free to get in touch. Our fresh pair of eyes can be a great help, so don't hesitate to contact us if you need help, even if it's just a shoulder to cry on. I've been asked many times about how I start the day trading, my sequence of events. So here's what I do. Firstly, I closely examine any open trades that I've still got from previous days for maintenance purposes. Sometimes that is as simple as taking profit. On other occasions it might be moving take profit levels or pending order levels. Then I look at the charts and I start with the 1-day candlestick chart and I work through the time periods, 4 hours, 1 hour, 15 minutes, 5 minutes, down to the 1 minute chart, and that gives me a feel for the trend of the market at the time I'm looking at it. Then I listen to the news and look out for any events that may affect currency exchange rates. Next I check out www.forexfactory.com to see if there's any significant UK, US or European economic news due to be announced during the course of the day. Next I make sure that Jeff's lines, or the Fitzpatrick pivot lines as some people call them, are in place. This means putting in the 50, 75, 100 and 150 lines away from the previous night's 10 o'clock opening time, and that's plus and minus those figures. However, on my computer, these are drawn automatically at 10 o'clock every night. I have a piece of software that does that. If you don't have that already, contact us through www.ravenglen.com to get hold of yours. The last part of my sequence only occurs if the time is between 6:30 a.m. and 8:30 a.m. when I go through the sequence. And I look at the 15-minute candlestick chart, and I'm going back over 10 periods. I want to see what happened between 4 a.m. and 6:30 a.m. If there's a strong trend upwards or downwards during that period, then there's a fair chance that that will continue up until around 8:30 a.m. and that might inform some decision making on my trade entries. The last part of my startup sequence is to check the forex climate. This is a screen which looks individually at the strength of currencies, including the pound and the dollar, against one another on a single chart, and this gives an excellent directional trading signal. The forex climate chart can be found at www.forexclimate.com. And here is the forex climate. Notice the green upward and the red downward arrows indicating changes in direction. These are the trading signals. Also, the two lines below, the green represents the dollar and the white represents the pound. And their closeness and how far away they are apart and when they cross over are all significant. And we'll look at these factors on the next slides. Notice that the forex climate chart that you've been looking at is for the pound dollar, and it's a 1 hour chart. There are also 4 hour and 1 day charts available, but I only tend to use these if I'm using the candlestick charts at the same time intervals. I really like the forex climate, and I'm often tempted to use it as my only indicator of direction. The important elements of the chart are the direction arrows, they're the green and red ones, and also the graphs at the bottom of the chart. The green line represents the dollar and the white line represents the pound. And we are looking at how these move in relation to the zero axis and whether the two charts are converging or diverging. Before we go, I want to check your understanding, or allow you to check your understanding, and to tell you what we might do in terms of the next steps. So let's look at what signals we might get from the forex climate. We've already seen the green and red direction change indication arrows. You'll notice that they actually also coincide with crossovers. So where there's a crossover, there's a green arrow, and that's the change in direction signaled. Then we have zero axis penetration. These occur when either currency moves from one side of the zero axis to the other. A move from below to above the axis indicates that the currency involved is strengthening against the other. Likewise, a move from below the zero axis indicates that the currency involved is weakening against the other currency. Then we have the scissor effect. A bit like a crossover, in fact it involves a crossover, but the two lines come from wide apart, crossover, and then move apart again. Looks like a pair of scissors, a particularly strong crossover. Then we have time period correlations. So if we get a good signal on a 1 hour, that's great. If the same signal appears on the 4 hour chart, that's even stronger. And if the signal then appears again on the 1 day chart, that's the absolute strongest we're going to get. So that's a forex climate. For your next steps, you need to practice, practice, and practice some more. Consider attending one of our advanced seminars and think about registering for the newsletter, from which you'll get a lot of information about news events and how to trade them. But also, keep in touch, let me know how you're getting on, and if you need any help, again, telephone or email, and we'll always respond. Thank you for going through the program.